We are quickly approaching the April 15th deadline, but after taxes are filed, how can you use that information to, in fact, diagnose missed financial opportunities so that you don't keep making those mistakes? We can take this opportunity to remind ourselves that if we're doing the last minute contributions, we've missed out on months of market growth potentially. A lot of us do focus on what we can do before April 15th. But once the return is filed, some say we can use our tax return as a diagnostic tool, Abe. So how can we do that? What can we use last year's, or in this case, this year's tax return to reveal as far as our opportunities, mistakes we're making now, to stop doing those that could benefit us as we get closer and into retirement?
Yeah, I have 4 things that, your current tax return can reveal, or 4 kind of insights from your tax return we should talk about. Number
Okay.
1, reoccurring tax surprises. So, if you're consistently owing money or getting a large refund, every year often signals withholding and income plan aren't aligned, right? So, if the same thing's happening year after year, then your withholding strategies, your income planning may not be, in sync. Adjustments should happen during the year, not just at filing time. Okay.
Okay.
So if
Yeah.
you're always getting a large refund, always owing a lot of money, there's a problem, right? You're not withholding enough money. You're withholding too much money. Really, ideally, at the end of every year, you're kind of just breaking even and you're doing
Yeah.
it right throughout the year, which means you're watching it. And on top of it, throughout the year, working with a good tax professional, working with a really good fiduciary financial advisor or retirement planner. Even better, the 2 of those professionals are in sync and speaking to each other, and you're speaking to them throughout the year. So you're getting it right throughout the year. The procrastination penalty, look, it's not a penalty, but it is if you think about it. If you're waiting till April 14th to get money in, it could have gone in 15, 16 months prior on January 1st of the prior year, and you just waited till April 14th. You just lost all that time. You just lost all that compounding and tax deferral, and the money could have been compounding. You could have been dollar cost averaging in every single month. You could have plopped the money in earlier in the year or last year and you just forgot or were just kind of lazy.
Mhm.
And maybe it is that you didn't have the cash to do it until now. If that's the case, then fine. But man, if you have the cash flow or the cash to put money in now is always better because you've got time and tax deferral and compounding interest you can take advantage of. Number 2, missed opportunities hiding in plain sight. A filed return can reveal unused deductions, credits, or tax advantage strategies that never got considered. The return should be reviewed as a part of a broader planning conversation. So, nearly every time we meet with a prospective client, we're getting to know who they are financially, what all their goals are for retirement. We look at the tax return. It tells a lot about what's going on in the picture, especially if they then want to start pursuing tax planning strategies like Roth conversions and things like that. We've got to look at the return and see what's going on and see where all the income is coming from and what types of deductions are taking. Are they taking the standard deduction or itemizing? And it tells a lot about who you are on that return and how you've planned in the past. Number 3, your income and investments may not be working together. The return can show whether assets are landing in the wrong accounts or generating avoidable taxes. We see this oftentimes too. Something that only becomes obvious once everything is reviewed together on paper. Okay. So sometimes we'll see unnecessary capital gains taxes. Sometimes we'll see people take a pension lump sum or do a Roth conversion and not withhold enough tax or withhold too much tax. We see it all. But the return, again, can be a diagnostic point, right? That we
Right.
can kind of get into and find out and discover what's going on. Number 4 from the article,
Yeah.
a lot of people say they're tax planning and everything like that, and they're just filing the return every year. That's not tax file. That's not tax, strategy. That's just filing the return on time. You're just looking at, and maybe that accountant or CPA is just looking at what's going on with taxes for that calendar year. That's not forward-looking proactive tax planning on your nest egg. That's just looking for the biggest tax break that year. But what if your nest egg grows to X amount of millions 5, 10, 15, 20 years from now? How are taxes going to play a part then? So number 4 from the article, no evidence of forward-looking planning. And this is really a big challenge. And you really want to find fiduciary planners or an advisor that can help you forward look out into the future, kind of predict what's going to happen and all the challenges and or opportunities that could come with a proactive tax plan. So no evidence of forward-looking planning. A strong warning sign is a return that looks exactly the same year after year, despite changes in income, markets, or life circumstances. That's when a tax return is a filing requirement, not a planning tool. And unfortunately, we see this all the time as well. Because again, no harm nor fault to accountants or CPAs, but they want to get the return done on time, right, for the client, and they're not looking out into the future, right? And they're just trying to help the client get the biggest tax break for that year, but not looking really at the nest egg and the millions of dollars typically someone has saved that we see people save, looking out into the future and saying, hey, how can we help lower our tax burden on our nest egg
Yeah.
and our assets as much as possible by doing proactive, proper planning in advance right now.
Yep.
So that if taxes go up down the road in the future, even by a few percent, and most people we see are going to be in the 12, 22, or 24% bracket. Even if taxes go up by a few percent down the road, which can mean higher taxes to you, more coming out of your accounts and pockets, less to your family and yourselves, more to the government, right? Then what can we do about it today? What can we do about it today? And, a great time is when one of the incomes has gone away, maybe one spouse is working or both spouses have stopped working, the working paychecks have gone. Now we're making decisions about when do we take Social Security? When do we take that pension? When do we start taking and how do we start taking dollars out of all of our accounts? Should we take cash out first before we take money out of the IRAs? When should we take Social Security? And all those considerations come into the picture when we're talking about tax planning and kind of really good timing when it comes to things like Roth conversions. Okay. And so you want to have someone that you're working with that's looking at the entire picture, that's looking at proactive tax planning, helping you maybe shift dollars, from pre-tax accounts to post-tax accounts, if and when it makes sense, running all the numbers for you. We use tax planning software, not to do the return, but to be proactive with tax planning.
Right.
Heather, if you're doing a tax plan with me, you would want to say, well, Abe, where is my husband's income right now? What bracket are we in today? Without any tax planning, where would we be if we did a $50,000 conversion, $100,000 conversion? What would that do to our taxes? Would it bump us up into a new tax bracket? What would our taxable liability be? Is it going to increase our IRMA Medicare premiums?
Yeah.
And is it going to
Lots of
increase
math that goes into
taxes
it.
on Social Security? All these kinds of things that you want to run and be aware of before you pursue something like that. But being proactive and really putting a plan together and exploring the possibilities and maybe the opportunities are the first steps, right? Get educated on what the options are and if they make sense for you. Just because it's a buzzword out there that a lot of people are doing and taking advantage of doesn't mean it's right for you right now, or maybe not even ever.
Case in point, Roth conversions. I mean, Roth is all people have been talking about the last 5 years.
Right.
And I know you've had first-hand experience. I know you've been sitting at the table with people and you're like, no, you shouldn't do a Roth conversion, or you shouldn't do one right now, or you shouldn't do one this way.
Right.
It's not for everybody, despite what you hear.
Sure.
So, of course, you Abe, and your team, you're here to show folks how things work, how they might work within their plan, customized to their goals, their objectives, their income levels. Because there's so much math that's involved. But at Abich Financial, they are here to help you understand how the math works for you and your plans. So if you're ready to start that conversation, theretirementkey.com is our website. We've also got links posted in the show notes. I also want to remind you about Abe's book, The Retirement Mountain, The 7 Steps to a Long-Lasting Retirement. Chapter 15. I'm surprised it took so long to get, there's just a lot to do, but chapter 15, step number 5 of the 7 steps is build a tax strategy. That's what we're doing here today.
That's right.
Having that conversation. But I know obviously the goal of all the things that you do, this YouTube channel, your podcast, radio shows, TV shows, writing this book, you just simply want to get the education into people's heads. Just know what your options are. Just empower you with this information, right?
That's right. That's right. Knowledge is power, and learning as much as possible, being educated as much as possible on your finances and all of the options you have to consider is the first step. And then that will help you to make good, informed decisions down the road.
It obviously can feel intimidating, confusing for a lot of us. That's why I also like to point out this book is just about just a little over 100 pages, easy read, maybe not even that, an easy read, reading a couple hours on a weekend. It's a great starting place to get some baseline information about how to build out a retirement plan. And then Abe and his team here to walk you through the rest of it. So if you want a copy of the book, lots of ways for you to get. You can buy the book on Amazon. We also have an audiobook on Amazon. If you come in for an appointment, we'll give you a free copy. You can download a free copy, a PDF version to read. Just wanting to empower you with the information. So click on the links we've got posted in the show notes or visit us anytime. theretirementkey.com. Let's get to work helping you figure out your tax strategy opportunities for retirement. It's theretirementkey.com.